Retail investors poured roughly $1 billion into Singapore REITs this year, while institutions dumped the exact same amount. If you are blindly buying the dip thinking retail numbers equal safety, you are miscalculating the actual forensic risk to your retirement. Today, we strip down the first half data of 2026 to reveal who actually holds the survival map. Here's what caught my attention. The headline numbers for real estate portfolios look grim, with the index posting a negative total return, while the broader Straits Times index hit record highs led by local banks. And underneath that split, I am watching two very different groups of investors place completely opposite bets on sticky interest rates. What we are looking at is a massive line drawn right down the middle of the Singapore property trust sector. On one side, you have retail investors in accumulation mode, soaking up around $1 billion worth of shares. On the opposite side, institutional money is moving in the exact opposite direction, offloading a nearly identical amount. Same assets, same market, but two completely conflicting strategies playing out simultaneously. This split happens because these two groups are not playing by the same rules or chasing the same goals. A growth seeker is chasing momentum and is perfectly fine taking on higher risk profiles for capital gains. But for a retiree, the priority is completely different, focusing on wealth preservation and establishing a dependable drawdown income. That requires a strict forensic standard designed specifically to protect hard-earned capital. Let's look at the hard data from the first half of 2026. The iEdge REIT Index dropped by negative 3.9% in total return, while the Straits Times Index surged by 13.7% to record highs, driven by the massive momentum in local banking stocks. A major drag here is the United States Federal Reserve keeping interest rates sticky between 3.50% and 3.75% through June, keeping financing costs elevated. But looking only at the index slide misses the core value proposition. A July report from DBS Group Research highlights that the sector is actually being priced with far more caution than the underlying real estate assets deserve. With average forward yields hovering around 6.2%, the trusts are trading below historical book values. And let's be honest, that specific valuation gap is exactly where a disciplined forensic investor finds mispriced opportunities. The fund flow data from the Business Times confirms this deep structural divergence. Retail accounts accumulated roughly $1 billion because they are laser-focused on generating consistent yield and cash flow. Meanwhile, institutional funds rotated out of the exact same volume to chase high-flying bank and technology momentum. While this data represents directional trends rather than perfect accounting matches, the underlying momentum is clear. So what does this mean for you? Institutional managers are constantly judged against short-term quarterly benchmarks, forcing them to chase the record highs seen in momentum sectors. The retail investor, particularly someone managing a retirement drawdown portfolio, is playing a much longer game where immediate monthly cash flow matters far more than short-term price fluctuation. Making a blanket assumption that retail is right or that institutions are always correct is a dangerous mistake. The reality is that broad market generalizations miss the point entirely. A proper forensic approach does not look at the crowd. It examines which specific trusts are continuing to produce genuine growing distributions and which ones are cheap simply because they are broken. Let us look at a concrete case study where operational resilience stands out against the index noise. In its financial year ended 31st of March 2026, AIMS APAC REIT grew its revenue by 2.16% to $190.7 million. More importantly, its net property income rose 5.7% to $141.3 million, proving it extracted higher efficiency from its existing assets to drive a 2.6% increase in full-year distributions. At a unit price of $1.64, that operational performance translates to a trailing yield of 6.01%, which sits comfortably above our 4.7% baseline hurdle for retirement income. The trust also bucked the broader trend by securing $18.07 million in net institutional inflows, proving that sophisticated capital will still buy quality assets. When institutional funds exit a sector entirely, they frequently leave high-quality operations trading at unfair discounts. This trust did not rely on complex financial engineering. It simply kept its properties occupied and collected the rent. Cash generation rather than price momentum must be the ultimate metric that determines whether a property trust deserves a spot in your long-term drawdown strategy. For a different structural signal, we can look at Centurion Accommodation REIT, which listed on the main board back in September 2025. This specialized vehicle focuses on purpose-built worker and student accommodation across Singapore, the United Kingdom, and Australia. A significant institutional signal appeared in July 2026, when global asset manager Cohen and Steers crossed the substantial shareholder threshold to hold a 5.004% stake. A sophisticated Selectors playbook splits the sector into two functional categories. You have distribution growth drivers like CapitaLand India Trust, Digital Core REIT, and Stoneweg European REIT, which use asset rotation to outpace interest costs. Then you have defensive income anchors like AIMS APAC REIT and Parkway Life REIT, which prioritize lease stability and capital preservation over aggressive geographic expansion. Before we examine the final verdict, let us get straight to the point. You are not watching this channel for superficial market hype or standard coffee shop gossip. You are spending your time here because you demand the unvarnished forensic truth before you commit a single dollar of your hard-earned capital into this market. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. Every investor who reviews this data without subscribing remains completely invisible to the platform. So take a brief moment to support independent research. When we look at the immediate wallet impact, the direct comparison reveals the true risk landscape. While the broad index exhibits standard caution and below-book valuations, a specialized name like Centurion Accommodation REIT offers a projected 7.5% prospectus forecast, but lacks a long historical track record. AIMS APAC REIT presents a historical 6.01% actual yield backed by solid net property income growth. To maintain complete data integrity, note that neither of these highlighted trusts currently carries an official forensic zone assignment. This data represents verified operating metrics from public filings rather than a final registry verdict. Our focus is anchored strictly on confirmed numbers like net property income efficiency and direct distribution yields sourced directly from official corporate announcements. Consider the practical impact for a 58-year-old retail investor living in Bedok, who is deploying SRS capital. AIMS APAC REIT provides a fully verified, currently paying 6.01% yield supported by actual rising rental cash flows. Centurion Accommodation REIT offers an attractive headline figure, but that 7.5% yield is purely a prospectus forecast that remains dependent on execution. Never allow an unproven prospectus forecast to replace the role of a verified, currently paying cash distribution. In a retirement drawdown portfolio, a missed projection translates directly into a painful shortfall in your actual monthly lifestyle income, not a simple spreadsheet variation. Treat all forward forecasts as liabilities on your income roadmap until they officially clear into your account as cold cash. So what does this mean for you? The extreme divergence between retail accumulation and institutional selling is an explicit warning to practice strict selectivity rather than buying the index blindly. Your focus must remain locked on trusts that exhibit organic net property income growth and distributions that are actively being paid out. AIMS APAC REIT clears that forensic bar today, while Centurion Accommodation REIT remains a name to monitor closely as its pipeline develops. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. Link in the description. The 7-day embargo window is already open for our members. If you want to skip the queue and access our complete toolkits, join Iggy's elite investors using the link below. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.